Hey, what's up everyone? It's Clinton. Welcome back to the channel where we break down complex financial topics and give you the tools to build your wealth. Today, we're diving deep into the world of Forex trading, and I'm going to show you how to predict Forex news like a pro. Now, if you've ever dabbled in Forex, you know how unpredictable it can seem. But here's the thing, it's not random. Economic news plays a massive role in those fluctuations, and understanding how to interpret that news can give you a serious edge in your trading. So if you're ready to level up your Forex game, buckle up, because this one's packed with valuable information. Alright, let's get straight to it. The first step to predicting Forex news is understanding the language it speaks, and that language is economic indicators. These indicators are like the heartbeat of an economy, providing vital signs that traders and analysts use to make informed decisions. These are data points released by governments and financial institutions that give us a glimpse into the health of an economy. They cover various aspects, from employment rates to consumer spending, and each one tells a different part of the economic story. Now, there are a ton of indicators out there, but some carry more weight in the Forex market than others. Understanding which ones are most influential can give you a significant edge. One of the big ones is GDP growth. Gross domestic product measures the total value of all goods and services produced over a specific time period. This tells us how fast a country's economy is growing. A rising GDP indicates economic expansion, while a falling GDP can signal a recession. Strong GDP growth usually signals a healthy economy, which can increase demand for that country's currency. Investors are more likely to invest in a thriving economy, driving up the currency's value. Think of it like this: if everyone wants a piece of a booming economy, they need that country's currency to invest, right? This increased demand can lead to a stronger currency. Next up, we've got interest rates. These are a major driver of currency values. These are set by central banks like the Federal Reserve in the US, and they have a huge impact on currency values. Central banks use interest rates to control inflation and stabilize the economy. If a central bank raises interest rates, it often strengthens that country's currency. Higher rates offer better returns on investments denominated in that currency. Why? Because higher interest rates attract foreign investment looking for better returns. This influx of capital can boost the currency's value. Then we have unemployment data. This is a critical indicator of economic health. Low unemployment generally indicates a strong economy, which can boost the value of its currency. More people working means more spending and economic activity. On the flip side, high unemployment can signal economic weakness, putting downward pressure on the currency. Fewer people working means less spending and slower economic growth. And finally, let's not forget about inflation reports. Inflation measures how quickly prices are rising in an economy. These tell us how quickly prices are rising in an economy. High inflation erodes purchasing power, making goods and services more expensive. High inflation erodes purchasing power, and central banks often respond by raising interest rates to try and cool things down. This can have a significant impact on currency values. So, keeping an eye on inflation is crucial for anticipating potential interest rate hikes, which can impact currency values. Understanding the interplay between inflation and interest rates is key. Now, this is just a taste of the economic indicators you should be paying attention to. There are many more that can influence the Forex market. There are others, like trade balances, manufacturing data, and consumer confidence, that also play a role. Each of these indicators provides additional insights into the economic landscape. The key is to understand how these indicators work together to paint a picture of an economy's overall health, and how that might influence currency movements. By connecting the dots, you can make more informed trading decisions. Do your research, study these indicators, and start connecting the dots between economic news and currency fluctuations. The more you understand, the better your trading strategies will become. The more you understand the fundamentals, the better equipped you'll be to navigate the exciting and potentially profitable world of Forex trading. So dive deep into these indicators and let them guide your trading journey. Okay, so now that you've got a handle on economic indicators, the next step is knowing where to get your news from. This is crucial because the quality of your information can make or break your trading decisions. Because let's be real, in the age of social media, anyone can post anything and claim it's the gospel truth. The sheer volume of information can be overwhelming. And trust me, the last thing you want to do is base your trading decisions on some random tweet from an unverified account. It's a recipe for disaster. That's why it's crucial to stick to reliable, reputable sources that have a track record of accuracy and credibility. These sources have earned their reputation over time. One of my go-tos is Forex Factory. This site is a treasure trove of information for traders. This website is like the holy grail of Forex news and analysis. It offers a wealth of resources that can help you stay informed. They have an economic calendar that's updated in real time, so you can stay on top of all the major economic releases. This is invaluable for making timely decisions. Plus, they have forums where you can connect with other traders and get their insights. It's a great way to learn from the experiences of others. Another great resource is investing.com. This site is a comprehensive hub for financial information. This site offers a wealth of information, including real-time quotes, charts, technical analysis tools, and of course news from various sources. It's a one-stop shop for traders. They cover a wide range of financial markets, but their Forex section is particularly comprehensive. You'll find everything you need to make informed decisions. And if you're looking for more in-depth analysis and commentary, you can't go wrong with Bloomberg or Reuters. These sources are known for their detailed and insightful reporting. Now, I know it can be tempting to check your Twitter feed or browse Reddit for the latest Forex gossip. But remember, not all information is created equal. Always cross-reference information with reputable sources before making any trading decisions based on it. This extra step can save you from costly mistakes. By sticking to reliable news sources, you can filter out the noise and focus on the data that actually matters. This will help you make more informed and confident trading decisions. All right, so you've got your economic indicators down, you've found your trusted news sources. Now comes the fun part, analyzing the data. This is where you connect the dots, see the bigger picture, and ultimately make informed trading decisions. Now, there are a few key approaches to analyzing news data. First, you've got pre-news analysis. This is where you look at the economic indicators we talked about earlier, compare them to previous data, and try to anticipate how the market might react to upcoming news releases. For example, if you see that inflation is consistently exceeding expectations, you might anticipate a more hawkish tone from the Federal Reserve, potentially leading to a stronger USD. Then there's the immediate post-news reaction. This is what we call the knee-jerk reaction. It's that initial surge or drop in currency prices immediately following a major news release. Now, while this can create trading opportunities, it's important to remember that the market doesn't always react rationally in the short term. Finally, we have to consider the longer-term impacts of news events. Some news releases have a more prolonged effect on currency valuations. Now, while understanding economic news is crucial for predicting Forex movements, it's not the only piece of the puzzle. Traders need to integrate multiple strategies to get a comprehensive view of the market. Technical analysis, which focuses on chart patterns, trends, and indicators, can be incredibly powerful when used in conjunction with news events. This dual approach allows traders to make more informed decisions. Think of it this way. Fundamental analysis tells you the why behind potential market moves, while technical analysis gives you the when and how. Combining these methods can provide a clearer picture of market dynamics. One of the most basic yet effective ways to combine technicals with news is by identifying key support and resistance levels on your charts. These levels act as psychological barriers in the market. These are price points where the currency pair has historically struggled to break above resistance or below support. Recognizing these levels can help traders anticipate market reactions. When a major news release coincides with a currency pair testing these levels, it can amplify the potential for a breakout or a bounce. This synergy between news and technicals can be a game changer. For example, let's say the Eurozone releases positive GDP data exceeding market expectations. Such news can have a significant impact on currency pairs. At the same time, you notice that the EU-USD pair is trading near a key resistance level on the chart. This alignment of news and technicals can provide a strong trading signal. This confluence of positive news and technical significance could signal a higher probability of a breakout above that resistance level. Traders should be prepared to act quickly in such scenarios. Another powerful technique is using momentum indicators such as the Relative Strength Index (RSI) or Moving Average Convergence Divergence (MACD). These tools can help confirm the strength of a trend or potential reversal. All right, so we've covered a lot of ground here. You've learned about economic indicators, finding reliable news sources, analyzing data, and even incorporating technical analysis. But none of that matters if you don't have a solid trading plan, because let's be real, even with the best analysis, trading around news events can be unpredictable. That's why it's crucial to have a strategy in place that helps you manage risk and protect your capital. First and foremost, you need to determine your risk tolerance. How much are you willing to lose on a single trade? This is not an arbitrary number. It should be a calculated percentage of your trading capital that you're comfortable losing. A common rule of thumb among experienced traders is to risk no more than 1 to 2% of your account on any single trade. Once you've established your risk tolerance, you can determine your position size. This is the amount of currency you'll buy or sell on a particular trade, and it should be directly correlated to your predetermined risk percentage. Next, you need to set your entry and exit points. One effective strategy for trading around news is to wait for confirmation before entering a trade. All right, everyone, we've covered a ton of ground today. We talked about understanding economic indicators, finding reliable news platforms, analyzing the data like pros, and even using technical tools to confirm our trades. Remember, predicting Forex news is like any skill. It takes time, practice, and a willingness to learn from your mistakes. Don't be afraid to start small, use demo accounts to practice your strategies, and gradually increase your risk as you gain experience. And hey, if you found this video helpful, hit that like button, subscribe to the channel for more financial tips and tricks, and share this video with anyone who's looking to level up their Forex game. So keep learning, stay informed, and I'll catch you in the next one.